Imagine money as a giant swimming pool. That's M2. It's all the cash people have, plus savings accounts and other stuff they can easily spend. When the pool is full, people feel rich, they spend more. When it's low, they tighten their belts, buy less. Simple. Smart folks with fancy degrees have looked at this. They found a link. When M2 goes up, the stock market usually follows. One study said for every 1% increase in M2, the market jumps about 0.5%. Not a guarantee, but something to think about. Section 4, History Rhymes. M2 up, market up. Remember the dot-com boom? M2 was surging, so were tech stocks. Then the housing bubble? Same story, different decade. And after the 2008 crash? M2 pumped up by the Fed, market roared back. Coincidence? I think not. Section 5, Liquidity. The oil in the market engine. More M2 means more money sloshing around. This makes it easier for investors to buy stocks. Like oil in an engine, liquidity keeps the market running smoothly. Less liquidity, things get sticky. Prices can drop fast. Section 6. The gist money talks, market listens. M2 isn't the only factor, but it's a big one. More money usually means more buying, higher stock prices. Less money? Watch out below. It's not rocket science, but it's important to understand. Section 7. Watch your wallet, watch the market. So what's the takeaway? Pay attention to M2. If it's growing, the market might be in for a good time. If it's shrinking, be cautious. Remember, knowledge is power, especially in the stock market.